Did you know that the average person loses nearly $1,000 per year due to inflation? That's enough to fund a luxurious weekend getaway. If that fact just made you rethink your financial strategy, then you're in the right place. Because today, we're talking about just that. Not just inflation, but also how it's silently eating away at your financial goals every single day. And most importantly, we'll share some practical tips on how you can combat inflation and protect your financial future. Yes, even in this economy. Before we get started, if you're new here, make sure you subscribe and hit that bell icon so you don't miss out on our next videos. Simply put, inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. But why does it even happen? Well, it could be due to increased production costs, like raw materials or wages, or because of increased demand for products and services. When demand outstrips supply, prices tend to rise. Now enough of the theory, let's talk about real life. Remember when a Netflix subscription cost around $8 back in 2010? Yep, a premium one. Fast forward to 2024, and you're looking at a basic plan that costs around $10, and a premium is up to $23. That's inflation at work. And it's not just your Netflix subscription. It's your groceries, your rent, your morning coffee. The cost of living in general tends to increase over time due to inflation. But there's another type of inflation that's even more insidious: lifestyle inflation. This is when your spending increases as your income goes up. Let's say you've just landed a new job with a hefty pay raise. You decide to celebrate by upgrading your car. Then, you start eating out more often because, well, you can afford it now. Maybe you move to a nicer neighborhood or start taking more vacations. Before you know it, your expenses have ballooned. And even though you're earning more, you're not really saving more. This phenomenon is what we call lifestyle inflation. Some people think it's all bad. But no, improving your standard of living isn't a bad thing. It's natural. The problem arises when your spending increases faster than your income, or when you're spending to keep up with others, or when your increased spending doesn't contribute to your happiness and financial goals. So, lifestyle inflation can be a slippery slope, but it's not the only way inflation is impacting your financial goals. Want to know more? Let's find out the first way inflation is affecting your financial goals. Decreased purchasing power. In simple terms, it's the amount of goods or services that one's income can buy. As inflation rises, the cost of goods and services also rises. And if your income doesn't keep up with inflation, your purchasing power decreases. Let's break it down with an example. Last year, you could buy a week's worth of groceries with $100. But this year, due to inflation, those same groceries now cost $120. If your income hasn't increased, you're effectively able to buy less with the same amount of money. That's decreased purchasing power in action. Want a kicker? Even if your income does increase, if it doesn't increase at the same rate as inflation, you're still losing purchasing power. So, if your income increased by 2%, but inflation was 3%, you're still behind. There are a few practical tips to combat decreased purchasing power. For one, budgeting. Keep track of your expenses and adjust your budget as needed. This can help you avoid unnecessary spending and make your money go further. You can also consider ways to increase your income, such as asking for a raise, switching jobs, or starting a side hustle. This can help you keep up with rising prices. Now, there's another side to this coin. As the value of money decreases, of course, the cost of living increases. That's the second way inflation is impacting your financial goals. You're living comfortably, meeting your financial duties, and even managing to save a little. Then, inflation hits. The price of gas goes up. Your weekly grocery bill is higher. Your rent increases. Suddenly, you're not living as comfortably as before. That's the increased cost of living in action. Keep in mind that not all costs rise at the same rate. Some expenses, like healthcare or education, may increase faster than others. So, while your overall salary increase might keep up with the average inflation rate, it might not keep up with these specific costs. To tackle the increased cost of living, you can try to live below your means. And no, we don't mean you have to live frugally. Rather, make conscious decisions about your spending. Prioritize your needs over your wants. You can also try to plan ahead. If you know that certain costs are likely to increase, plan for them in advance. For example, if you expect your rent to go up next year, start saving now. Moving on, inflation can also sneak in and nibble away at your hard-earned savings. Let's say you've got $1,000 in a savings account that earns 1% interest per year. At the end of the year, you'll have $1,010. Not bad, right? But wait a minute. What if the inflation rate is 2%? That means the cost of goods and services has gone up by 2%. So, while you've earned $10 in interest, the purchasing power of your $1,010 is now less than what your $1,000 could buy a year ago. That's the impact of inflation on your savings. Apart from the money you've already saved, it can impact your future savings as well. If your income doesn't keep up with inflation, you'll have less money to save. And of course, that's going to have a big impact on your financial goals, whether it's buying a house, starting a business, or even planning for retirement. To protect your savings, consider putting your savings in a high-yield savings account that offers a higher interest rate than a regular savings account. Next up, the fourth way might be close to your heart: your investments. When you invest, you're hoping for a return on your investment, right? You put your money into stocks, mutual funds, bonds, real estate, or other assets, and you expect them to grow over time. But inflation can eat into those returns. Let's say you've invested in a bond that gives you a 3% return per year. Sounds good, right? But what if inflation is the same 2%? That means the real return on your investment, the return after accounting for inflation, is only 1%. And you know what? That's before we take into account any fees or taxes. Now, you see how inflation is killing your goals. There's another thing to consider. Not all investments are created equal when it comes to inflation. Some investments, like certain types of bonds, might not keep up with inflation. Other investments, like stocks or real estate, might do a better job of keeping pace with inflation. But of course, higher potential returns often come with higher risk. The best pro tip you can get is to diversify. Spread your investments across different types of assets to help protect against inflation. And make sure to review your investment portfolio regularly to ensure it's still aligned with your financial goals. Time changes, you know. It's 2024. Next up, the fifth way is actually a trap very easy to fall into when dealing with inflation: overspending. When you see prices going up, your first instinct might be to buy now before things get even more expensive. You might think you're just keeping up with inflation, but in reality, you might be spending more than you need to. And that can simply lead to a cycle of overspending that's hard to break. For a better understanding, let's hear a story of Sam. Sam is a hardworking guy in his late 20s who recently got a promotion at work. With the promotion came a significant pay raise. Excited about his new financial status, Sam decided to upgrade his lifestyle. He moved into a bigger apartment in a nicer neighborhood, bought a new car, and started dining at high-end restaurants. Life was good, or so it seemed. As the months rolled by, Sam noticed that his expenses were steadily increasing. The cost of maintaining his new lifestyle was higher than he had anticipated. His rent was higher, his car maintenance costs had gone up, and dining out was becoming quite expensive. But Sam wasn't too worried. After all, he was earning more now, right? Then, inflation hit. The cost of groceries went up. Gas prices increased. Even the cost of a movie ticket was higher. Sam found himself spending more and more money just to maintain his lifestyle. And because he was spending so much, he wasn't able to save as much as he used to. Before he knew it, Sam was caught in the overspending trap. He was living paycheck to paycheck with no savings to fall back on. He realized that he was spending more than he needed to, and it was affecting his financial health. So, what did Sam do? He took a hard look at his finances and made some changes. He created a budget and started tracking his expenses. He cut back on unnecessary spending and started saving more. But what can you do apart from making a budget? Well, a practical tip here is to distinguish between your needs and wants. It's okay to treat yourself, but not at the expense of your financial health. Another tip many successful investors follow is setting clear goals. Having clear financial goals can help you stay focused and avoid unnecessary spending. Well, that's it for today. Inflation might be a silent enemy, but it doesn't have to be a deadly one. If you enjoyed the info in this video, we'd love to hear from you. Have you experienced the impact of inflation on your financial goals? What steps are you taking to combat inflation? Drop your comments below, And if there's any topic you'd like us to cover in future videos, let us know that too. Before you go, don't forget to check out our video on the 10 golden rules of money management that will transform your financial situation. Make sure you hit that subscribe button and press the bell icon. Thanks for watching.